When the creator of digital currency, Satoshi Nakamoto, first released Bitcoin, no one could have predicted that it would fundamentally change the global financial world. Since then, Bitcoin and other cryptocurrencies have undergone a journey filled with countless ups and downs, massive whale movements, liquidation crises, and historic crashes. Today, we will examine the entire chronological journey of Bitcoin, from its inception to the tumultuous October of 2025, step by step. During this process, we will analyze not only price changes, but also long and short risks in the market, major liquidations, and the strategic moves of investors. If you're ready, let's embark on the journey through the greatest digital currency saga in history. The birth of Bitcoin and Satoshi Nakamoto. At the end of 2008, while the financial crisis was still shaking the world, a person or group published a white paper under the name Satoshi Nakamoto, Bitcoin, a peer-to-peer electronic cash system. This paper proposed creating a digital currency without the need for central authorities. The goal was to eliminate trust-based intermediaries in the financial system, make transactions faster and cheaper, and enable direct value transfer between users. Satoshi Nakamoto chose to remain a mysterious figure. His identity remains unknown. This anonymity was a critical factor aligned with Bitcoin's decentralized structure, preventing any leader or central figure from controlling the market. While establishing Bitcoin's technical infrastructure, Satoshi also materialized the concept of blockchain. Blockchain essentially consists of linked blocks. Each block is connected to the previous one, and all transactions are recorded immutably. This structure ensures system security without a central authority. In 2009, the first Bitcoin block, known as the Genesis block, was mined. This block was not just a technical beginning, but also carried a symbolic message, critiquing the traditional structure of the financial system. Mining began with this block, producing new Bitcoins and validating transactions, ensuring the network's security and integrity. The first transactions and Bitcoin's initial value. In 2010, the first recorded Bitcoin transaction occurred. Laszlo Hanyecz purchased 2 pizzas for 10,000 Bitcoins. At the time, Bitcoin had almost no value, but today this transaction would be worth millions. This event marked the first tangible example of Bitcoin moving from theory to practice. In the early years, the Bitcoin community was very small. Forums, discussions, and user experiences formed the foundation of the ecosystem. Early miners secured the network using their computers while earning new Bitcoins. Mining played a critical role in the growth of the system and the verification of transactions. (2011) Initial fluctuations in Bitcoin's value growth. In 2011, Bitcoin surpassed $1 for the first time, quickly rising to $31 before plunging back to $2, providing investors with the first real test of volatility. This period highlighted speculative nature of the market and the importance of investor psychology. In the same year, the first altcoins such as Litecoin emerged. Litecoin was designed to increase transaction speed and use different mining algorithms. Altcoins expanded the decentralized structure and digital currency concept introduced by Bitcoin with alternative variations. By the end of 2011, Bitcoin's value remained unstable, but the community began to grow. Tech enthusiasts shared knowledge on forums, discussed mining experiments, and laid the foundations of the digital currency economy. In 2012, community growth and technical developments. In 2012, Bitcoin's technical infrastructure matured. Mining pools emerged, allowing smaller miners to combine resources for greater power, improving network security and transaction speed. During this period, the potential of blockchain technology became increasingly recognized. Bitcoin attracted attention not only as a currency, but also as a technology that made financial transactions transparent and secure. 2013, Bitcoin's first major surge in the Mt. Gox crisis. 2013 saw Bitcoin's first significant surge and first major crisis. Bitcoin reached $266 due to trading activities in China, attracting global investor attention. However, technical problems and security vulnerabilities at the Mt. Gox exchange caused Bitcoin's value to plummet. The Mt. Gox crisis pushed Bitcoin from $266 to $50 almost overnight, shaking investor confidence and triggering panic in the market. By the end of 2013, Bitcoin remained an attractive investment for early adopters and tech enthusiasts. Yet, the lack of regulation, security risks, and speculative movements highlighted the market's fragility. Investor psychology and early bubble experiences. Between 2011 to 2013, investor psychology began to form. Panic selling, FUD, fear, uncertainty, doubt, and early bubble experiences left long-lasting effects. The first bubble bursts taught investors the importance of risk management in the cryptocurrency market. Blockchain technology's robustness kept the system operational during these crises. Its immutable and transparent record system continued to provide a sense of security for investors. Development of altcoins and blockchain. After 2013, altcoins diversified. Ethereum, Ripple, Dogecoin, and others entered the market with different use cases and technical features. Ethereum introduced smart contracts, enabling decentralized applications. Ripple offered fast and low-cost banking payment solutions. Dogecoin gained value through community influence. Blockchain's applications outside finance also began to be explored. Logistics, insurance, and gaming sectors were among the first to experiment with the technology. 2014-2017, post-Mt. Gox recovery, altcoin rise, and ICO boom. 2014, crisis and the beginning of recovery. 2014 marked a critical recovery period for the Bitcoin community. The Mt. Gox crisis at the end of 2013 had shaken investor confidence worldwide. As the largest Bitcoin exchange at the time, Mt. Gox's collapse caused billions in losses. Investors questioned Bitcoin's reliability, but the decentralized nature of blockchain prevented the system from collapsing entirely. Panic, liquidity issues, and FUD influenced investor psychology. By the second half of 2014, Bitcoin gradually recovered, trading between $300 to $500. Blockchain security became a major trust factor for users and investors. Altcoins like Litecoin, Ripple, and Dogecoin gained attention. Litecoin aimed to increase transaction speed and reduce payment costs. Ripple focused on fast interbank transfers, gaining prominence in the corporate finance sector. Dogecoin, initially created as a joke, gained value due to strong community support. 2015, the rise of Ethereum and smart contracts. 2015 was a turning point for blockchain technology. Ethereum, developed by Vitalik Buterin, introduced smart contracts, forming the foundation for decentralized applications, DApps, and DeFi projects. Ethereum's introduction expanded blockchain use beyond finance. Insurance, gaming, and logistics projects began to proliferate, proving that altcoins offered technology-driven value, not just speculative investment. Bitcoin traded between $200 to $500, while altcoins gained momentum with Ethereum's launch. Early adopters experimented with long-short strategies. Despite volatility, the market remained attractive for investors. 2016, community and ecosystem growth. 2016 saw community growth and ecosystem maturity. Mining pools and stronger infrastructures enhanced network security. Bitcoin traded between $400 to $700, while altcoins continued to gain value. Regulatory discussions accelerated. Japan, the U.S., and European countries began establishing legal frameworks for cryptocurrency markets, contributing to long-term market stability. Blockchain projects expanded into non-financial sectors. DeFi foundations were laid, and smart contract applications attracted investor interest. 2017, cryptocurrency explosion and ICO craze. 2017 marked a peak year for the crypto market. Bitcoin reached $20,000 by year-end. Ethereum, Ripple, and other altcoins rose rapidly. The initial coin offering, ICO boom, allowed projects to raise capital quickly. Some achieved huge success, while others collapsed due to fraud or technical failure. Investor psychology was influenced by FOMO and greed, increasing market volatility. Long-short positions and leveraged trades posed serious risks. DeFi projects and DApps proliferated rapidly, allowing investors to engage in decentralized borrowing, lending, and investing. By the end of 2017, the crypto ecosystem had matured technologically and socially. Yet speculative behavior, lack of regulation, and volatility continued to present serious risks. altcoin and blockchain diversification. The altcoin ecosystem diversified in 2017. Litecoin, Ethereum, Ripple, Cardano, Neo, and others emerged with various purposes. Ethereum stood out for smart contracts and dApp ecosystems. Ripple offered interbank payment solutions. Blockchain applications expanded beyond finance into gaming, insurance, logistics, and data management. This diversification created new opportunities and risks for investors, strengthening the ecosystem. Investor psychology and market dynamics. From 2014 to 2017, investor psychology was shaped by panic, FOMO, greed, and risk management experiences. Long, short positions, leverage, and volatility remained critical considerations. These years represented a period where the crypto market offered both opportunities and risks. With technological advances and regulatory frameworks, the market matured, and investors became more informed. 2018 to 2021, major crashes, pandemic, and recovery. 2018, the beginning of the crypto winter. 2018 was a year of major disruption for Bitcoin and altcoins. After reaching $20,000 at the end of 2017, Bitcoin lost value throughout 2018, falling to around $3,200 by year-end. Altcoins saw losses of 80 to 90%. During this period, investors experienced firsthand the high volatility and risks of cryptocurrencies. Leverage trading, long-short positions, and panic selling led to significant losses. Liquidations provided harsh lessons and emphasized the importance of risk management. Regulations also influenced market movements. Governments in the U.S., Europe, and Asia took steps to protect investors and regulate the market. Despite the decentralized nature of cryptocurrencies, these measures made the market safer and more sustainable in the long term. Investor psychology was shaped by panic, fear, and uncertainty. Many reassessed long-term strategies, while some exited the market entirely. Experienced investors viewed this period as a valuable lesson in risk management and strategy development. 2019, recovery and market stabilization. 2019 marked a period of partial recovery. Bitcoin rose from $3,200 to around $7,000, $8,000, and altcoins gained value in parallel. Blockchain applications expanded with DeFi protocols, decentralized apps, and smart contracts being applied outside the financial sector. The community grew, and more knowledgeable investors entered the market. Institutional investors began returning. Bitcoin ETFs and digital asset funds contributed to market maturity. Long, short positions and leverage remained risks, but regulatory measures and investor experience helped limit losses. 2020, COVID-19 pandemic and crypto surge. 2020 was marked by the global financial turmoil caused by the COVID-19 pandemic. Amid uncertainty, investors sought alternative assets. cryptocurrencies emerged as a safe haven and a store of value. Bitcoin initially fell to $4,000, but quickly recovered, reaching $29,000 by year-end. Institutional investments from MicroStrategy, Tesla, and other major companies boosted prices. Long-short strategies and leverage continued to pose risks. Investors developed new approaches to manage volatility and diversify portfolios. 2021 Historic peaks, DeFi, and NFT explosion. 2021 was a record year for the crypto market. Bitcoin reached $69,000, Ethereum $4,800, and the DeFi and NFT ecosystems expanded rapidly. DeFi, decentralized finance, enabled lending, borrowing, and investing without intermediaries. Users could perform financial transactions directly on blockchain platforms. NFTs, non-fungible tokens, gained popularity in digital art, gaming, and metaverse projects, becoming both collectible and investment assets. Institutional investors, large funds and corporations invested in Bitcoin and Ethereum, adding liquidity and driving prices upward. However, China's mining ban and regulatory debates in the U.S. maintained market volatility. Long-short positions, leverage, and speculative trading remained key risks. Blockchain technology, DeFi, and NFTs broadened use cases. The market became more resilient and mature, with investors gaining experience in strategy, risk management, and portfolio diversification. Investor psychology and market dynamics. Between 2018 to 2021, investor psychology evolved through panic, greed, FOMO, and risk management lessons. Long-short positions and leverage were essential factors to monitor continuously. The rise of DeFi and NFTs provided new opportunities, but also heightened volatility and risk. Institutional participation increased liquidity and contributed to market maturity. 2022 to 2025, crises recovery and the October 2025 crash. 2022 to FTX and Terra crisis. 2022 was a year of historic turmoil. The Terra, UST Luna stablecoin crisis and FTX exchange collapse shook global investor confidence. Terra crisis. The algorithmic stablecoin Terra USD UST failed to maintain its $1 peg, causing Luna tokens to rapidly lose value. Millions in investments were wiped out, exposing the risks of algorithmic stablecoins. FTX collapse. In November, FTX faced liquidity and trust issues, leading to bankruptcy. Billions of dollars in user funds were frozen. Centralized exchanges' transparency problems severely damaged investor confidence. Many investors using long-short strategies and leverage suffered substantial losses. Liquidations highlighted the critical need for risk management strategies. By year-end, Bitcoin traded between $16,000 to $20,000, while altcoin losses reached around 80%. These crises prompted stronger regulations and improved security measures. 2023. Recovery and Stabilization. 2023 saw partial market recovery. Bitcoin fluctuated between $30,000 to $50,000, with altcoins regaining value. Institutional participation returned, and Bitcoin ETF and digital asset funds provided stability. Blockchain adoption expanded beyond finance, DeFi, gaming, insurance, and the community grew. Long, short positions and leverage remained risks, but regulation and investor experience limited losses. 2024. Bitcoin and altcoins reach new peaks. In 2024, Bitcoin approached $70,000, restoring investor confidence. Altcoins like Ethereum, Solana, and Cardano gained value in DeFi and NFT ecosystems. Institutional influence increased, with major funds and companies incorporating digital assets into portfolios. Long, short positions and leverage remained critical risk factors. Blockchain projects matured, offering smart contracts, decentralized apps, and NFT platforms, adding variety for investors. The market became more robust and resilient, learning from previous crises. 2025 October crash and volatile months. 2025 marked one of the most turbulent periods in crypto history. January-September, Bitcoin fluctuated between $90,000, $120,000. Altcoins, NFTs, and metaverse projects attracted investor attention. Long, short risks remained a focus. October 6th, Bitcoin reached a yearly peak of $126,000. October 10th to 11th, 2025, US-China economic tensions triggered panic selling. Bitcoin fell to $104,000. Altcoins dropped sharply. October 12th, approximately $19 billion in leverage positions were liquidated. Short positions profited, while market fear indexes hit extreme levels. October 13th, Bitcoin partially recovered to $114,000. Altcoins regained value, but the market remained cautious. This crash highlighted how volatility and investor psychology affect price movements. Risk management, leverage use, and market analysis became critical for investors. Post-2025 Overview and Future Outlook. From Bitcoin's creation to 2025, cryptocurrencies evolved rapidly both financially and technologically. The market experienced numerous ups and downs, with major crises and crashes. Blockchain technology and digital asset popularity did not decline. Instead, it diversified. Investors gained extensive experience with long, short positions, leverage, and volatility. Institutional entry and enhanced regulations made the market safer and more sustainable. Post-2025, Bitcoin and other cryptocurrencies are likely to remain integral to the financial system. The growing adoption of blockchain and digital assets is expanding market accessibility. Cryptocurrencies will continue to offer opportunities and risks. Volatility, long-short positions, leverage, and market psychology will remain key factors for investors.